Episode 21 TNG Podcast, here with myself and Mitch Rodruck. We are the Nickla group, and thank you guys for watching. We got a couple of things to talk about today. We had, what was our last show? Who was it? Who was 20?
Ryan Olenkowski.
Ryan, yep, great show. It's been 2 weeks since then, right? And we had a trip in between, a leadership retreat, which was good in San Diego.
Awesome time, beautiful weather, good content, just all around good time to be had by all.
Today we're going to talk about a couple different, one local story going on at South Lake Mall. The second thing we're going to talk about is the recent briefing from Jerome Powell, the chairman of the Federal Reserve, how that affects markets, interest rates, and then kind of segue from there, talk a little bit about the real estate market and what we're seeing. Obviously, a lot of craziness going on there and things changing. So, Mitch, how you been?
Been good, dude. Been good. I think that...
Tell the viewers who care.
Yeah.
How you feel, man?
Look right into the camera. Feel good. I think that this podcast is well-timed because of coming off the Fed meeting, and a lot of people ask me what that means for their mortgage rate, so it's going to be good for the viewer. How are you, Al?
I'm great, man.
Well, no, don't tell me. Look at the camera.
I'm good. I'm great. San Diego was awesome. It was a great trip. We had the opportunity to be around. So it was a leadership retreat from our coaching company, which, for you guys who don't know, Tom Ferry is he's the son of the original
OG.
The OG real estate coach, Mike Ferry. Tom branched off years ago and built his, and now it's an ecosystem of the best realtors across the country. So we've been involved in this ecosystem now for years. I've been coached by them personally, and now we have a coach for our entire team. So Mitch and I went. It was a leadership retreat, and we went and got to meet literally and network with, and it was a more intimate of an event than a lot of their others. So we got to meet with all the team leaders across the country. And for context, our team did about 200 transactions last year, and it was about 53 million in sales volume. We were around people doing 1,000 to 3,000 transactions and doing 1 billion to 3 billion a year in sales volume. So significantly larger than us, and being able to meet those people was good. A lot of takeaways from it. So I'm hoping to bring that back. It was good timing for the shifting market that we're in too. So it was good. So I'm doing great, man. A lot of things I think have been in the works since then. Yeah,
got to meet the who's who of the Tom Ferry Network. Got to meet Tim Grover. That was pretty cool.
Dude, I can.
Phil Jones, author.
Phil Jones, not too many
Tom himself.
Phil,
we got to talk to him for a while.
It was amazing.
It was a good perspective. I don't really know the word, but give you a better perspective. You know, you got to go to those places you talk about all the time to almost humble yourself. Not that we're not humble people, but when you're sitting next to these people that are doing close to $1 billion or over $1 billion in sales as a team, it's hard not.
Yeah, not brokerages, teams. So
teams.
Like a team doing that, it's pretty sweet, man.
Yeah, totally.
Yeah, so it's been good. We get to learn from those people. Had a great call with a follow-up call yesterday, right? Was that yesterday?
That 2 days ago? 2 days ago.
With, someone that we met there to kind of help us in building our business. So hopefully bringing back more value for all of our clients, and then also for our team to help us all grow. So excited about that for sure. We got one story locally today we want to touch on, and the first one is going to be, it's in regards to South Lake Mall. So a lot of us region folks have, our thoughts and our views on South Lake Mall, and malls across the world are struggling, or across the country are struggling, being redeveloped into different projects. So a little bit of an update for Carson's, right? So South Lake Mall's Carson's being transformed into a pop-up retail, co-working mall, sports, and event space. A California-based company plans to reimagine, this is an NWI Times story. California-based company plans to reimagine the long vacant Carson's department store at South Lake Mall in Hobart. CubeWork, a company that specializes in flexible workspaces built to suit office spaces, industrial warehousing, acquired the two-story, 144,000 square foot department store. It's been vacant since 2018. Plans to transform the former department store into a pop-up retail space, co-working mall, and indoor sports and indoor sports and events venue. Businesses can rent kiosks and pop-up shops to test the market for their goods and services. CubeWork will rent kiosks for as little as $590 a month, as well as fully furnished pop-up spaces where entrepreneurs can place their products on already installed shelves. It's offering short-term leases in high-traffic retail spaces, as well as warehouse units ranging from 2,000 to 10,000 square feet. It's pretty interesting. Let's see, it's marketing the CubeWork shops at South Lake Mall as an open-air enclosed creative space specifically designed to get your business out of your garage, self-storage facility, or home office. Amenities include Wi-Fi, utilities, janitorial services, all that stuff. CubeWork is also building out a co-working mall in the 2-story space that's been empty for the last 4 years. It suggests business owners could transform suites into indoor sports venues like indoor kids gyms, Pilates, yoga studios, CrossFit, esports, such as airsoft, laser tag, escape rooms, gaming lounges, batting cages, virtual golf, indoor pickleball fields, and much more. CubeWork hopes to open move-in ready spaces as soon as November 15th. That's 11 days from now.
Right around the corner.
I think it's a sign of good things to come to the mall. As where is it? Yeah, Aaron McDermott of Latitude. Shout out to Aaron and Latitude down the street. Great commercial brokerage in the area. Say it's a good sign for the mall being redeveloped, and so on. So pretty unique setup, right? Kind of cool, because again, what's happening with malls across the country, a lot of them are becoming Amazon fulfillment centers, some of them apartments, some of them a whole bunch of different things. So what's your thoughts on 144,000 square foot and Carson's turning into this? What do you think?
I mean, I think it's a good thing. I think that when I look back at like growing up in the regions, the South Lake Mall was a staple, man. That's like, for sure, as a kid, that's where you go back to school clothes shopping. And when you're in high school, like that's where you go hang out with your friends, just walk around aimlessly. Like, good times to be had there, and it's sad to see what's happening there. And you're right, it's all across the country, so it is interesting to see how different people are trying to solve that same puzzle. What do we do with this massive infrastructure where everybody nowadays can get something delivered to their house the next day, same day, 2-day shipping? How do we, fill this space? And I think this is a great way to do it. Chop it up, offer it to small business owners, offer it to gyms, Pilates, CrossFit, indoor sports, youth sports. Think about like golf simulators. Think about self-storage units in there. There's all kinds of good uses. The highest and best use of the mall has shifted from retail to other things now. So yeah, I'm excited for it, man. I hope that more than just Carson's makes changes like this. Yeah, well, the thing is how many companies need, obviously department stores, right? How many companies need 144,000 square feet? It's really only industrial buildings. Most of those industrial buildings are being built out as brand new buildings, and most of them are here in Crown Point. You can see off I-65, both east and west of I-65. There's all these brand new, huge industrial buildings going in where these, A-class buildings, long-term tenants and leases. I mean, 144,000 square feet is a lot of square feet, and it's 2-story spaces. So in a retail space, who needs 144,000 square feet of retail? Very small buyer pool. But when you chop that up, it's a very interesting model, but it makes sense too. CubeWork, I like the idea of CubeWork, right? Because it's kind of like all the above. You're going to have offices, but you're also going to have other things. So they're basically taking 144,000 square foot and turning it into like retail, shopping, office, industrial store. Like they're doing all of it into one. Very interesting use of the space, but it's creative. Hopefully, what is it going to do to the mall? Hopefully it brings some good businesses. I like the idea that, when they talk about entrepreneurs and people bringing in something small to have it, and they could say, yeah, we're in the mall in the old Carson's. That could help a lot of people's value too, or value their businesses too, as far as high traffic. So, there wasn't going to be another big department store going in there. No way. Right? Yeah. So what was going to go in there? And they probably got a pretty damn good deal on the price, considering it's been there for 4 years. I wonder what that transaction looked like. But it makes sense. Yeah. It's interesting. I don't know enough about like what CubeWork looks like in other spaces, but it sounds like a pretty cool idea. Yeah, it totally sounds good. I'm excited to see the execution of it. And one thing that comes to mind is, where else can small business owners, somebody that runs something out of their house, where can they test products? Right. Like, this sounds like a great opportunity for a lot of small business owners. We're moving into the winter in the region, and you don't got those farmers markets to go test things out. And exactly. Whereas like in other states, you can test product all year long, just on your own, popping up. So
exactly, man. It'll be interesting to see. I mean, do I think it's a bad? I don't think it's a bad thing. I think it's a good thing. I mean, It could potentially be a great thing.
Could be great.
Provides value to to a lot of different people, not just one company that's going to come and do one thing.
Yeah.
Again, who's looking for 144,000 square feet of retail? Really nobody.
List.
Yeah. So let's go to our second story, big one in the real estate business. So the Federal Reserve approves a 75 basis point hike, which is essentially 0.75% rate hike, 2 rates, highest since 2008, and hints at a change in policy ahead. He kept saying, Jerome Powell kept saying, who's the chairman of the Federal Reserve, he kept hinting that we still have a ways to go, and this is necessary. And so for the people who don't necessarily know the details on this, what caused this, and with everything that happened with COVID and all the uncertainty, we had to print a lot of money. And when you print a lot of money, that's what inflation is. The cost of the dollar was going down because there was more of them out there, right? If there's one of something, it's very valuable. If there's more of it and you keep making more of it, it becomes less and less valuable. Thus, what we saw in real estate, and also that's why they made rates go to essentially free. Like money was free money. So now, because they printed so much money, because there was so much spending and inflation was out of hand, they have to raise rates to slow things down. They just did another 75 basis point, 0.75%, which I had a closing I just came from. Buyer's interest rate was 7%. If he would get a loan today, that same loan is probably going to be about 8.25%.
Yeah.
9-12 months ago, we're at 3.5%. So big shift, and they're still indicating that once, potentially twice, they are seeing that it's still necessary to do even more rate hikes because we printed so much money that is having an effect on what's going on. Ultimately, it's going to have an effect on the economy if it already hasn't already. So what are your thoughts on this?
Thoughts are, this is necessary to curb inflation in the long run. It's not sustainable to keep going at the rate that we were. And it really reminds me of the recession that happened in 1981. Obviously, we weren't around then. But I did a lot of research on it. The recession was very similar to what we're dealing with today. Obviously, not exactly similar, but basically they had a ton of government spending and call it what it is, poor monetary policies that led to high inflation. So the Fed had to raise rates to slow down consumer spending and try to curb inflation. Big differ from that time to now is back then unemployment was closer to 11%, which thankfully is not something that we're dealing with now. It's closer to 2.8% as of this morning. That recession lasted 18 months, and the Fed had to keep the rate high to slow down spending. So one thing that you just said that reminds me of research that I did last night and this morning is the Fed had trouble predicting how high they needed to raise rates to slow inflation. That's something that Jerome Powell said that, there's going to be more, essentially. He alluded to higher rates in the future, not slowing down anytime soon. At its high back then, mortgage rates went to 16.6%, and then post-recession, it went to 13.2%. So 3% peak to trough there. Yep. 75% of unemployment came from manufacturing, residential construction, and auto manufacturing. I think that all those industries are going to see a slowdown now too. Mm-hmm. Obviously, there's a big demand for all those things coming out of the supply chain issues that we had. But if people can't afford to purchase those things, I totally see layoffs happening. And let's hope that they don't. But all in all, home prices rose during the 1981 recession 3.5%, according to Current Matters. So
good notes there.
That's what this reminds me of.
Yeah, the ultimate, what I hate about all this is that obviously COVID was extremely unpredictable, and when early on we had no idea what was going on. Halfway to 3/4 of the way through, it was pretty clear that, of course, a lot of people lost their lives from this. At the same time, though, when it comes to the monetary side of things, a lot of people needed the money. Taking people out of work, shutting down the economy. It was crazy stuff. But the underlying truth is the fact that when they printed all this money, it did help a lot of people who needed it. But I don't know about you, and I would ask people around you, and a lot of people can probably attest to this. How many people do you know that were like, yeah, I got $1,200, $2,400, I got this. I'm still working. I'm actually making more money.
Didn't need it. Yeah.
How many of those people did not need that money? I think that
good percentage.
I think that the vetting process of printing money was very, very poorly done. Now, what is that? What's the result of that? And what is the consequences of that? It's this. It's this right here, what we're experiencing. And what's ironic about it, and the average person doesn't understand this, and I didn't understand this until now seeing it, the money by the government was being printed for the sake of helping out the person who was struggling, and many of them did get helped out. The unfortunate reality of what happens now is at the end, it might have helped them out at first, but who does it hurt the most?
The people that needed it.
It hurts the people the most who needed it. So the unfortunate part is, who does it benefit the most?
The people who own assets.
The people who don't need the money.
Yeah.
The money flew up to those people. And do you think that it matters to the billionaire that a gallon of gas is $6? But does it matter to the family that needed that money in COVID that a gallon of gas is $6?
Absolutely.
And the problem now is that these are just, unfortunately, it was bad policies with money, man. Like, it sucks because now the response is they have to raise interest rates. And what's that going to do for the economy? People who can't afford to purchase a home are now going to have a much harder time purchasing a home or getting a place to rent, because rents don't go down in these periods of times. They stay stagnant typically. So it's going to affect the people who need it the most. It's so crazy. And I get it. But the unfortunate part, it's not that we shouldn't have helped people out during COVID. It's that how many of those people were helped out and didn't need that money? I mean, PPP loans too, man. Like, if you needed them for your company, great. We didn't take $1 from PPP because we didn't need the money. And because other people needed the money. We never applied for PPP. I know people who were like, oh yeah, dude, our business was killing it. We got $100,000, we got $200,000, we got $30,000, we got this, we got that. It was just money created and printed out of thin air. And the result of it now is this. Yeah. It is sad, man. And it's people who it didn't, like, it benefited them short term, but long term, it's going to put those people into tough positions, and it just sucks to see. And related to our business now it's going to, and we're going to talk about this a little bit more, because now that we're going into real estate side of it, is it going to slow down the real estate market? Yes.
Absolutely.
Yeah. If you take the exact same priced home and you take the interest rate now versus 12 months ago, you're talking about $1,000 to $1,200 more a month on their monthly payment. Is that going to affect people buying homes? Yes. Yeah, absolutely. Is that going to slow down demand? Yes. Yeah. Right? So that being the case, though, I think it's very important that we differentiate the difference of the region versus the rest of the country.
Yeah, exactly.
And you did some deep research on that, and I think that's something, if you want to touch on that a little bit, the difference of, because we are heading into a recession. They need a recession to happen. Right? They need a recession to happen because they have to limit inflation, they have to limit spending, but doing it without such a hard landing, crash landing, they're saying. So talk about that, because for people, our business is home values. That's what we do, and real estate values. So we're going to talk about that. We don't know all the other details and all the other stuff. That's not what we do. The real estate side, though, I think that we can talk on. But I think it's really important to distinguish the difference of, everybody out there now is like, well, I'm waiting for the rates to come down, waiting for the market to crash, so on and so forth. What happens in Miami and Austin, Texas is a lot different than what happens in Northwest Indiana. So I think we need to look at that and the difference of what will happen with real estate here versus the rest of the market. So go ahead, man, with what you had and research that you've done, because you dove deep into that.
Yeah, so I did a deep dive into comparing Northwest Indiana statistics during the great financial crisis of 2008. Comparing that to the national scale. I'm not saying, this is a big pretense here, I'm not saying that we're going into another 2008. I don't think that we are. Mm-hmm. The people have too much equity in their home for us to go into that, and we can touch on that. But basically what we found is that, and I can share these stats with you, Noah, to put the graphic up. We saw far less volatility on a region level as compared to the national level, and one thing that we didn't perform as well on was the average home prices rebounding. I put something up on my story today about it, but essentially homes across the nation dropped faster, they went farther down, and they came back up and recovered a little faster than ours. That doesn't shock me when you add in markets that skew the data on the national level, like Miami, Denver, all across California. These are markets that are highly volatile, and I know you're writing down notes on it, so I'll let you get into it. But essentially, we stayed more level. We did have a dip, but when you compare it to the national level, it wasn't a huge valley and then a big rebound. Eventually, we did rebound. We just kind of lagged the national scale. It took us longer to get there, back up to where we were pre-financial crisis. So,
yeah, and I think some things to keep in mind when you're paying attention right now to the news. Number one, be careful. Any major news outlet is probably not a good place to go. I'd find some people who independently talk about these things, because there's a lot better data and information when it's not biased. That's just my initial view of listening to all these other places and finding out good information. Because here's the thing, what you're going to hear is everything that's bad, because that's what sells. Fear sells, and fear gets eyeballs and attention. When you hear what's going to happen with the real estate market, it's all doom and gloom and it's nightmares. Are things going to slow down? Yes. Are there going to be less transactions? Yeah. 2020 and 2021 are anomalies and will never happen again in real estate from the size, the amount of price appreciation and closings. Like, we're back to a normal level of closings right now. It feels different because I used this analogy before. For 2 years, we were just driving 120 miles an hour on I-65, and we just got off on 109th, and the speed limit is 35 miles an hour, and you're not used to going 35. You feel like you're not moving, right? So we're used to that. Are interest rates going to stay high, or we're not used to that? Are interest rates going to stay higher? Yeah, they're going to stay higher. They need to be, right? They need to be higher because the rates we had the last few years, which again, we got used to, are not normal, right? And so that being the case, you got to be careful on what you listen to online, because they're going to highlight what happens in Austin, Texas, which, by the way, it had the biggest increase. It's going to have some of the biggest decreases. Miami, Florida, same thing. When you look at Northwest Indiana, I can't see the value of a 4-bedroom, 2.5 bath, 2,400 square foot home with an unfinished basement on a 1/4 acre lot in a great neighborhood with 10-star schools, which is such a huge, overwhelming majority of this area in Northwest Indiana. I don't see that having a problem in Northwest Indiana, because the truth is, when things go bad and we have a recession, we have the benefit of being in the 3rd, 4th largest metro in the country, and people wanting to get out of a state that's struggling financially with significantly high taxes. So when that happens, I think it's important to look at these numbers too. If you look at 2007, 2011 prices, nationally they went down from the peak of 2007 to the trough of 2011, the low point. In U.S., 14.6% was the average that home value lost. In Northwest Indiana, it was 10%. So about 33% or so better here than the rest of the country, right? And then in terms of number of closings, it's about the same. It was only about a 10% difference, but down 40% in terms of number of transactions, and here it was 37 in Northwest Indiana. But the point is, transactions are still being had. People are still buying and selling homes. But in Northwest Indiana, because of the protection that we have, I think when things go bad, more than ever, people are going to want to come to the region. But
Absolutely.
Why though? We have great schools. It's a safe place to live.
Low taxes.
There's things to do. Is there as much to do in Chicago? No, there's not as much to do in Chicago, and there never will be.
No.
But do we have great restaurants to go to in Valpo and Crown Point and Hobart and all these areas? Yes. Do we have things to do in the area that for kids and for families? Yes. Is it as much as the city? No. But for what you get for your money, and safety, security, education, schools, things to do, and the access to Chicago to use it when you want to, all of those things right there are only making Northwest Indiana more and more valuable, only attracting more people from suburbs of Chicago and parts of Chicago to Northwest Indiana. So ultimately, when things go bad there, where are they going to look to?
They go here.
This is going to be an option. It's going to be an option for a lot of people whose families are still in Illinois and Chicago, and they want to get out of those higher expenses and costs of that living, and they're going to look here. I don't think we need to equate the rest of the market and nationally nationally in those bigger markets and the doom and gloom you're going to hear versus what's happening in Northwest Indiana. And I'm convicted in the fact that this is still going to be a great market. Number one, if you look at, again, statistics from 08, but you look at now, and back then, not many people from Illinois were moving here. We have to keep that in mind.
Yeah.
Like, if you talk to people from the region, back then, we weren't seeing the amount of people leaving Illinois at that time.
No,
they just weren't.
Just think about the square, like, as far as things to do. Like, we're on the square right now. That's why I bring it up. I'm looking at it. But you can look around here, and you have phenomenal restaurants and things to do, coffee shops on the square that in 08, when you know, it hit the fan, you didn't have that here. So you didn't have that allure. You didn't have that lifestyle here. You did have the stability. You had the safety, and you had the schools here. But as far as entertainment goes, we're in a much different place across the region, not just the square. You got more restaurants down in Lowell. You got everything going on in Valpo. Michigan City's got their big development.
Yeah.
You got the Dunes as a national park now. I mean,
access to Michigan for stuff like there if you want to get away from, like, I was talking to a buddy yesterday or 2 or 3 days ago, and he's like, dude, I remember before, man, because we're trying to find him space for his business. He's like, dude, I remember before growing up here, like, they couldn't pay people to lease out space on the square.
Oh my goodness.
And now, like, you can't get it. And that's all, like, you look in Valparaiso and everything going on. So when you factor everything that you just mentioned, all of that in, I think we need to keep in account that back in 05 to 2012, people weren't really moving here from Illinois in the amount that they are now.
Yeah.
In the amount that they are now. So when things get bad, we need to separate the fact that the region's going to have different results because we have that ability, and also because our prices aren't hyperinflated.
No.
Now, if you bought a 2-bedroom condo that's 1,200 square foot and you paid $400,000 for it somewhere in the region, you might not want to sell it next year. That's
hold on to it.
Yeah, like, I don't think your value is going to go up, right?
No.
But the majority of this market is what I had mentioned, a 3-2 and, you know, in a nice neighborhood and good schools. You know, a 4-bedroom, 2.5 bathroom or whatever in these nice neighborhoods. This is a family driven, for the most part, area. So are we going to see, and with millennials being the largest buying pool in history, now getting into the buying years, more and more of those millennials in Chicago and Illinois are going to look for places to send their kids for safety, security, schools, and again, things to do. And more people I talk to from Illinois are like, you know what, man, it's not a bad place to live. And damn it, I agree. I'm born and raised here,
man.
and it is a great place to live. And I'm proud that my kids get to grow up here and my family is here. Like, it's a great place to live. So I feel entirely differently than what's going to happen in the rest of the country with 8, 9, 10% interest rates. Is it going to be a different market? Yep, and it needs to be. But we need to differentiate what's going to happen in the region. If you're saying you want to wait for the market to crash, I don't think you should hold your breath.
Not in the region.
Not in North.
No.
What'd you say?
Not in the region.
Exactly.
I mean, if you're looking for a market to crash, then set up a home search in an area that boomed like crazy during, you know, the pandemic.
Yep.
That's the thing. You know, just a couple months ago, I would be talking with let's say I'm taking a first-time home buyer out and their parents come to the showing. The parents would be saying something like, I can't believe you're trying to buy a house right now. Everything's so inflated. And now I do follow-up calls to those people, and they're like, I'm so glad I bought a house when I did. Locked in a 3.5% interest rate. You know, talk about things last year, even lower than that. You know, people are so happy about that. And it's still not a bad time to buy if you have to buy. But, you know, it's just like time heals all wounds in real estate. If you think that you're putting yourself in a bad spot by buying a house, like, just wait long enough and you're gonna look like a genius, you know.
Yep.
So
heck yeah.
That's my soapbox.
Heck yeah. Thanks for the TED Talk.
Yep.
Dude, thanks for all this info and numbers.
Yeah,
if anyone's interested in it, maybe it's important to link it up. I mean, someone might want to look at that.
We'll shoot a link up, and then I'll get these notes so he can put them somewhere up there.
Cool. Thank you guys for watching. Next week, we have a cool show. We are expanding our commercial team. So we are bringing in a very, very, very high level woman who's going to be running our commercial division for the Nickla group. So we're very excited about that. We're going to have Laura on the podcast next week, so you guys will get to meet her, and everything. Good stuff coming. So thank you guys for watching. Appreciate it, and we'll talk to you soon.